Hello, and welcome to our first of its kind Options Masterclass. I'm Eric Bleeker, and I'll be your host for today's big event. With options investing interest at some of the highest levels we've ever seen, our goal today is to arm every single Motley Fool member with the information strategies they need to confidently and quickly begin using specific, not to mention incredibly easy to follow, investing techniques that have helped tens of thousands of members just like you profit from options for more than a decade now. So over the next hour or so, we'll peel back the curtain on these techniques and explain why, for investors who are willing to follow a specific plan, we believe there's never been a better time to begin using options in your portfolio to do things like use what we're calling the trifecta trade to dramatically increase the returns upside you're hoping to achieve from popular Motley Fool recommendations like eBay, Disney, PayPal, and Facebook by 2x, 3x, and sometimes even 5x or more. The trifecta trade is so powerful because it actually allows you to put less money on the line up front to set yourself up with higher return potential, all while giving your thesis more time to play out in the process. And we'll even walk you through a recent Motley Fool recommendation employing the trifecta trade to show you just how to set up options trades in a brokerage account from start to finish, to show you precisely how simple it is. We'll also show you how to employ options to set up consistent and repeatable income generating machines in your portfolio. And toward the end of our options masterclass, we also have a massive announcement, the likes of which we have not made in a full half decade now, which you definitely will not want to miss. But before we dive in any further to today's discussion, I want to bring in my co-host today, the head of messaging at the Motley Fool and a successful options trader himself, Michael Douglas.
Hi, Eric. Thanks for having me. Great to be here today. So for those of you at home, thanks so much for tuning in to join us. I think we're going to have a lot of fun today, and I think you're going to learn more about options investing in a short time frame than you likely ever thought possible. In order to do that, I have a simple request to start us off. Forget everything that you think you know about options. Forget every horror story you've heard about how risky options are, how somebody's second cousin lost their shirt, shoes, and toy poodle trading them. Forget all the Greek letters, the deltas, the gammas, and all the complicated terms that make options trading sound like a foreign language. Because the dirty little secret that Wall Street doesn't want you to know is that you don't have to take big risks to make big money with options. And investing with them doesn't have to be complicated, which we'll prove to you later on when we walk you through the real-life trifecta trade that Motley Fool Options recently recommended. It's very simple. In a little bit, I'll also introduce you to perhaps the single most gifted options investor I've ever met, the man behind Motley Fool Options, our one and only research service 100% dedicated to delivering options recommendations to Motley Fool members like you. And I'll also show you how easy it is to execute options trades like the one this investor and his team have employed in the trifecta trade in order to help dedicated members magnify their upside by as much as 4x versus what one could have achieved by simply buying and holding the underlying stock like we normally do. For the skeptics out there, this part is important. We're going to show you how these incredibly outsized returns are entirely achievable without taking on huge risky bets like the ones you've likely seen in the news over the past couple of months with so-called meme stocks like GameStop and AMC. The team behind our Motley Fool Options service has used the strategies you'll hear about today to help members like you make money on a staggering 86% of the option strategies they've closed. 86%. And to reiterate, they've done so without taking big risks in the process. Not only that, but they've done it for more than a decade and counting with tens of thousands of members, most of them options novices just like me when they first joined.
Yeah, and Michael, I want to jump in and quickly re-emphasize this because it bears repeating. Our team of options experts started with something most investors consider highly risky, scary, or even downright dangerous in options, and they turned them into amazingly consistent tools for maximizing upside and generating cash income that should make even the most bun-down investors feel comfortable. We're holding this options masterclass event today because after a 2020 that was possibly the, I think you could call it the wildest stock market that any of us have ever seen, as hard as to believe 2021 appears to be off to an equally wild start. Plus, with interest in options trading at an all-time high, we firmly believe it's more important than ever that you understand the incredible power of properly using options to maximize your portfolio upside in the years ahead. And best of all, you can generate income whether the market goes up, down, sideways. That's because with options, you can make money from soaring, falling, or even sideways moving stocks. And if you've been following the craziness of what's going on in the market over the past few weeks, you can see why that would give us such a tremendous advantage in our portfolios. And you don't have to rely on steadily rising market for your returns. Far from it. And you can do it while risking less capital up front. When you use options the Motley Fool way, we believe, and our track record of making money on 86% of our option strategies we've closed backs this up, it's possible to seriously enhance your long-term portfolio returns without loading up on trades that essentially amount to lottery tickets. So let's go ahead, let's jump into the meat of today's event and walk you through some of the strategies you'll see Motley Fool Options recommend most often.
Yeah, and I think you teed it up really well, Eric. So let's start by taking a closer look at the perspective of an investor who's bullish on a stock, excited about a company, and wants to go long, right? You're seeing an opportunity. You think the stock's going to appreciate in the future. You can buy a call option, which is one of the most basic options trades that there is. A call option at its core becomes more valuable as the price of the underlying stock increases. It's a bet on the stock's price increasing. Conversely, the option loses value as the underlying stock's value decreases. So buying a call is a way to profit as the stock rises. It's a way to really magnify those profits potentially. And it's a really great way to be bullish on a stock while limiting the amount of money that you put at risk. For example, the underlying stock may only gain, say, 20%, but that could cause your call option to shoot up 100%. And so you can see that real opportunity to magnify that potential upside. Meanwhile, you may be risking a mere 10 or 20% of the amount of money that you would put into the market for the option to control 100 shares of the stock. And when we talk through our actual sort of real life trades, you'll see a little bit more about this. Whenever the stock market is volatile or uncertain, like right now, buying call options can be a great way to take advantage because you're still getting into the market, but you're able to put far less money at risk. Yet even though you have less money at risk, you have leveraged upside. Again, that magnifying opportunity. So if the market starts soaring, you're actually going to make more in returns than you would have just by buying those underlying shares. It's not like you're capping your upside or anything. Precisely the opposite, in fact. You're giving yourself this opportunity to really magnify it.
Yeah, so let me check off, just to make sure I'm getting the full picture here, especially for our viewers. When you buy calls, you spend less money up front, and you potentially give yourself more upside. Michael, I know they say a sucker is born every minute, but that seems too good to be true to me. Seriously, what's the catch?
Sure. You caught me, Eric. There is one catch here. It's time. You see, every options contract has a specific expiration date, and if the parameters of the contract aren't fulfilled in time, the option expires worthless. Because here's the problem. If the stock didn't move higher, the option would expire worthless. You'd lose the amount that you paid in for the option contract in the first place. And whether you're a seasoned investor or someone who's only just started investing, you know that in the stock market, well, just about anything can happen in a short time period. And that's the big mistake we see far too many investors make when they begin trading options. They bet big on trades that only have a few days or weeks or maybe even a few months to pay off. That's not investing, Eric. It's gambling. Our Motley Fool Options team still approach options as investors first and foremost. And that's precisely why they've often recommended what they believe is a far safer but still incredibly lucrative strategy. It's a form of buying call options that gives long-term investors like us here at the Motley Fool far more time for our bullish thesis to play out. Now, unfortunately, based on conversations I've had with Motley Fool members over the years, many of them aren't even aware this particular strategy is readily available to them. Lately, we've been referring to it as the trifecta trade, which you talked a little bit here at the beginning. We think of it as a three-way win because it allows you to put less capital at risk up front to give yourself more upside on a stock while also giving yourself years for your investing thesis to play out. Now, in the options world, the trifecta trade involves buying what's called long-term equity anticipation securities You may have heard of them commonly referred to as leaps. Leaps are just like call options in that they allow investors to make a bullish bet on an underlying stock they love while getting leverage returns, potentially magnifying, again, those returns in the process and risking far less money up front. But instead of needing the stock to move your way next week or next month or just a few days from now, you can actually get multiple years for your stock to move higher. Talk about putting time on your side. So not only do you get all the same attractive features of a regular call option, but you don't have to bet on a short-term outcome in order to magnify your upside. Instead, you get to kick back and watch your long-term bullish thesis play out just like you would in a normal Motley Fool investment. Now, if you know what to look for when buying leaps, you could potentially 3x to 5x your money by executing these trades on rock-solid companies, just like the ones you already find in flagship Motley Fool services like Stock Advisor and Rule Breakers. That's a far cry from the way most people use options, which is to buy a short-term call on some fly-by-night company, hoping for a quick, easy payout, and then, unfortunately, all too often losing all their money. We're doing the exact opposite, Eric.
Okay, so again, less money up front, more potential upside, and more time for that to happen. I would call that trifecta, Michael. And what I would love to see now is, could you give some examples of how leaps would work on some of those prominent Motley Fool recommendations you just referenced?
Absolutely. So let's start with one of the oldest Motley Fool recommendations out there, eBay, a company we're all pretty aware of, right? I hope. David Gardner recommended it in Stock Advisor all the way back in 2002. And it's had an incredible run since then. It's now up more than 1,600% over the past couple decades. Now, eBay stock trades at around $60 today, and for just $848, you could buy a $65 call that expires all the way in January of 2023. So again, that's $848 versus spending $6,500 to directly control 100 shares of the stock. So you can see just how much less money you're putting at risk here. So if the stock goes up 25% by January of 2023, we break even right off the bat. Great. But here's where it gets really interesting. Is if eBay stock goes up around 33%, our trifecta trade would be making around 87%, almost 3x the return that the stock would be making. If eBay shares go up 50%, we're looking at around a 200% return. That's 4x what the stock would be making. And if eBay shares go up 100%, we'd make roughly 550%. It's a whopping 5.5x return. Now, you might be saying, oh, okay, sure, Michael, eBay is already a $41 billion company, and again, pretty well known. How realistic is for them to go up 100% from here? Well, it may surprise you to learn that just over the past year, eBay has actually shot up 95%. And instead of just a single year to do that, we'd be setting ourselves up with nearly 2 full years to get there. What's more, as I mentioned earlier, we'd be paying just $848 up front to control that $100, those 100 shares worth of upside. If we just bought eBay shares outright like normal, we'd have to pay, $6,000 on day one.
Yeah, and I think we need to pause here to emphasize to members, this isn't all theoretical. We've actually done this here at the Motley Fool inside our very own option service, where we have a track record of making money on 86% of our completed option strategies.
Yeah, absolutely, Eric. And that's one of the immediate things that really attracted me to Motley Fool options. As you can imagine, somebody makes 86% of their trades. Look, that's interesting. Motley Fool options uses a variety of options trades, and one of them is, the leaps or trifecta trade that we've been talking about. And like you said, this isn't all just theoretical. So I'm going to prove that to you by showing you an example of a trifecta trade that our options team recommended on Disney. Let's rewind back to 2013 really quick. So our options team was extremely interested in Disney as a stock, because even back then they loved the potential of the Marvel franchise, smart call as it turns out, and thought the market still had no idea just how big the Marvel franchise and universe could be, which, I'd say, in retrospect, pretty fair call. That was despite Disney being priced at $69 at the time, which was already an all-time high for the stock. So our team recommended that members buy leaps on Disney with a strike price of $60, meaning the leaps were already what we call in the money, since the strike price was lower than the actual price of the stock, which is $69, with an expiration set in 2016, more than 2 years later. Because that contract was both already in the money and had an expiration date so far in the future, it was somewhat pricey, $1,333 per contract, in fact. But here's the thing, Eric. By buying a leaps contract instead of buying the stock outright, the team paid as I said, $1,333 to control 100 shares of Disney stock for a duration of 2 years. If they'd simply bought Disney shares outright at the time, they would have had to pay $6,900, more than $5,000 more to control the exact same quantity of shares. That's 5 times as much money up front. Remember the trifecta: less money up front, more upside potential, and years for your thesis to play out. And as successful as Disney has been over the past few years, I'm sure those of you at home can guess what happened. By January 2016, Disney's stock price had shot up from $69 to nearly $100, or roughly a 45% gain if you bought shares outright. Hey, certainly not bad for a little more than 2 years, especially with a mega cap company like Disney, right? So how did our options team's trades perform? Well, because of our leveraged upside, instead of a mere 45% return, we made a whopping 188% return on our initial investment, or 4 times what you would have made by simply buying shares, Eric. And remember, you can buy as many contracts as you're comfortable with. You don't have to just buy one at a time.
Yeah, and those gains are not only impressive as an absolute amount of 188%, which nobody's ever going to complain about, but particularly in relation to what you would have made otherwise. 4x the returns, but importantly, for a mere 1/5 the capital at risk up front. That's a pretty good deal, in my opinion.
Yeah, and one of the things that I appreciate about the Motley Fool Options team is that because the service has been around for a decade, they've got a lot of experience with this, right? And again, that 86% win rate on, or profitability rate on closed trades. And so let's give you another example, since we were talking about eBay earlier. How about PayPal, which spun out of eBay years ago? This is actually an active trade inside Motley Fool Options, meaning that while we could close out the position and lock in our gains whenever we wanted, we've yet to recommend doing so. You're about to get a bit of a look behind the curtain here. So back in April 2020, our options team recommended setting up Leaps on PayPal when the stock was trading at $110.55 per share by buying deep in the money calls at a strike price of $75 that wouldn't expire until January 2022. So again, almost 2 years later, giving us nearly that 2-year runway. And again, we use the term deep in the money because the current price of the underlying stock, in this case PayPal, was already far higher than the strike price of the call we're buying. So how are we looking nearly a year in? Well, PayPal's already shot roughly 120% over that time period. Not bad. Again, right? More than a double in less than a year. I think pretty much everybody's going to be happy with that. On the other hand, our Leaps that initially cost $4,289 are currently worth a whopping $16,703, nearly 4 times the original value, and we still have nearly an entire year's runway ahead of us. What's more, while that initial $4,289 that anybody following that trade had to shell out may seem steep, by buying those calls instead of buying PayPal shares outright, we actually risked $6,766 less in upfront capital. Yet again, the trifecta trade allows us that long timeline, nearly 2 years necessary, to ultimately make more money, again, that 4x that I was just talking about, and put less on the line to do so. And the thing is, I could go on and on with these examples, Eric. There was a 2014 trade on Facebook Leaps, netted us an 88% return on just a 46% market move, nearly 2x the return would have had from just buying shares outright. And a modest 25% gain in Ferrari stock has already netted us a smooth 70% return on Leaps that don't expire until December of this year. Like I said, I could keep going, but the point being, buying Leaps is an incredibly powerful investing tactic when you want to leverage more upside out of a stock's movement while spending less capital up front to control a large number of shares.
Yeah, and those are pretty amazing examples. But when I talk to investors about options, the number one comment I get is they sound complicated. So the question I'm wondering, listening to all those examples, is just how complicated are Leaps? I'm not guessing just anybody can use them.
Actually, Eric, this is the funny thing. They're actually incredibly simple to set up. In fact, I'll just share my screen and show you. Let me pull up my brokerage account and we can walk through a real life version of the trifecta trade that our Motley Fool Options team actually just recommended directly inside the service. So I'm going to share my screen really quickly. Okay, great. So what I'm going to do is walk you through how to do a trifecta trade on Take-Two Interactive. That's ticker symbol TTWO. This is a live rec in Motley Fool Options, and as you mentioned, Eric, a very recent one. So I start by putting in my ticker symbol right here, TTWO, and it immediately fills in a lot of the information. Now, I'm using Bank of America's Merrill Edge brokerage. That's just my personal brokerage. Obviously, yours probably looks a little bit different, but the key parts should essentially all be the same. So I'll buy to open a single call, and I'm just mirroring the options team's trade here. Their recommendation was to buy a call with a date of January 20th, 2023, strike price $115, and as we mentioned, a call. Okay, so that's filled in all the information. So let me just stop here and recap. For it to be a trifecta trade, it requires 3 components. First, less capital upfront. So if you look at where this trade would execute at right now, it would cost me about $7,340, roughly speaking. Buying those underlying shares, of course, would cost me just under $18,000. So I'm saving over 10 grand, less capital upfront, check. Second is more upside than buying underlying shares. So by my calculations, looking at the potential outcomes here, because these calls are deep in the money, we paid a pretty steep premium, $7,340 to get to set them up. We only need the stock to gain about 6% or so from today's price to be in a break-even position right away. So for me to get all that money back, all that has to happen is the stock to increase 6% sometime between now and January 20th, 2023. That seems pretty doable. But also bear in mind that the stock has gone up 50% in the past year alone. So there are a few other potential outcomes. If stock goes up around 36%, we'd make 75%. Okay, that starts to get interesting, right? If it goes up around 50%, like it has over the past year alone, we'd be making 113% returns. And if it's up 100% by January 2023, well, in that case, we'd be looking at right around 230% or so returns. So 2.3x what you get otherwise. Or look, let's just say everything about the thesis really plays out and Take-Two takes off and goes up 200%, so it triples in value. We'd be making right around 478%, which is nearly a 6x total run-up and greater than 2.5x what you'd otherwise make. So more upside than buying the stock? I'd say check, right? And the third piece is giving yourself years for the investing thesis to play out. And again, that price only has to move in our direction at some point between now and January 20th, 2023. Yeah, that's plenty of time. Check. So, and you can see here that they've kind of laid it out. My brokerage just kind of laid it out here. The maximum amount that I'm risking here, $7,340. The estimated break-even price on the shares, about $188.40. And Merrill says there's quite a bit of potential maximum gain to put it lightly. So then what I just simply do is, a few clicks, preview order, and then I would hit submit and it would go. That's it. It's really a very surprisingly simple yet incredibly powerful trade. And look, I know what a lot of you at home are probably thinking. Yeah, okay, the fool's able to do this, and they spend all day looking at options trades and they watch it like a hawk. That doesn't mean I'll be able to do it myself. And then I say, hey, look, just look at me, right? I've been with the Motley Fool for about 7 years now, and I've worked everywhere from editorial to our wealth management team, to member experience and retention, to marketing. Like most people here at the Motley Fool, I'm a hobby investor, but I'm certainly no investment analyst. I have a full-time job at the Fool, on my church council. I've got a 1-year-old kid at home. Point being, Eric, I do not have a lot of free time in my life right now. I certainly had no idea how to trade options when I first started looking into it. I could barely tell you the difference between a call and a put. And frankly, if you'd asked me to explain the math behind an options contract, I would have broken out into a cold sweat. That was until I finally decided to take advantage of our Motley Fool options service for myself. And listen, for me, I had always seen the potential for options. I saw how people could use them to magnify their gains and just do really incredible potential things with their portfolio, trimming losses. And I thought, gosh, I want that to be me, right? I mean, I invest for my family's well-being, for my kids' future, for all the same reasons I think anyone else does. And I realized, and the thing that I realized was that failing to use options was a big issue holding me back from realizing the full potential of my portfolio in the stock market. And so I went to Motley Fool Options, and the thing that I most appreciate about the service, aside from obviously the 86% win rate, which is to me just such a clear signal of the team's expertise and ability when thinking about who to follow, for options recommendations, is how simple and accessible they make it. I mean, frankly, they would probably explain everything that I just did with that Take Two trade a lot better than I would, right? They break each trade down as simply as I just showed you, and they've got a bunch of great content that really helps members visualize trades and really understand how they work. Frankly, in my opinion, it's the best investment education I've ever received, and it's all thanks to Jim Mueller and the options team.
Yeah, and speaking of Jim Mueller, I've had the pleasure of working with him for 12 years at the Motley Fool, and I want to pause and introduce him. After all, he is the lead advisor of Motley Fool Options and the brains behind today's masterclass presentation. Jim's also the expert I mentioned earlier who oversees everything we do here when it comes to the profitable universe of options trading. And if you ask me, there's no one better suited to the job. Jim is, hands down, one of the most talented options investors I've ever met. So, you must be wondering who traditional buy and hold investors like Motley Fool founders David and Tom Gardner would ever trust to regularly issue option trade recommendations on the Motley Fool's behalf. And, the answer is simple. It all comes down to Jim Mueller, the investor who first taught himself to trade options and then went on to share the secret with thousands of fools just like you, proving that you don't need to take wild risks in order to significantly enhance your portfolio's potential upside. Well, he's too humble to admit it. Jim is what I would call a brainiac. After learning how businesses are run while putting his PhD in biochemistry to use at a small biotech company, Jim discovered that investing was more lucrative and equally fulfilling as a career path being stuck in a lab all day. And since joining the Motley Fool a decade and a half ago, Jim earned his CFA designation and, more importantly, the respect of even our most vaunted investors. Today, Jim spends nearly every waking hour engaging with our Motley Fool community and trying to teach them just how powerful options can be when properly used in one's portfolio, and how it's probably a lot easier, safer, and, let's face it, more profitable than you think. Michael, back to your initial introduction to options. When you were combing through the site as somebody who, as you said yourself, is a parent, full-time on your church council, not a lot of free time on your hands. So was there a particular option strategy that stood out to you as an investor at that point?
Yeah, it's a good question, Eric. And it was an amazingly powerful strategy that Motley Fool Options has used time and time again to generate income. It's called writing put options. It's basically the complete opposite of what we were just discussing with the trifecta trade. Instead of buying leaps, we're selling, or it's also sometimes called writing, since we're the ones creating the option contract itself, puts. The put option is the exact opposite of a call. It becomes more valuable as the price of the underlying stock decreases, and it loses its value as the underlying stock increases. And because we're the ones selling the contract instead of buying it, we're also the ones getting paid up front. Meaning that instead of trying to capture big time upside on a stock over a longer time period, we're generating immediate income right up front. It's a method that many of our members inside Motley Fool Options have used in order to turn their savings or investment portfolio into a veritable cash cow. And we think it can be especially useful once you're in or near retirement and are no longer guaranteed a steady paycheck. And Eric, it may surprise you to learn that I personally did it on frankly, I think the single most popular and successful Motley Fool recommendations of the past half decade. A stock you all probably know, Shopify. Now, I'm going to ask our producer, Heather, to quickly show up a chart here of my complete history selling puts on Shopify over the course of 2017. Look at some of the income I was able to rack up here. $292, $432, $382, $442, $312, $172, $402, $472, $322. You kind of get that that sense of just kind of what you can do here. It's a little bit like a football coach sticking with a call that the other team just can't stop. In total, I ran the exact same play 9 times for a total of $3,230.61. Because when it's working, why stop? And look, Eric, I like to think I'm a reasonably smart guy, but you don't have to be a genius to do this. When you have somebody holding your hand, it really doesn't take that much time, and it really doesn't take that much effort. And remember, 75% of the time, the option is going to expire worthless anyway, and so you can just keep writing another one and collecting even more income. That's exactly what happened time and time again for me with Shopify. 9 times, to be exact.
Yeah, so I want to pause for just a second, because I'm sitting here, I'm watching those numbers as all the viewers are at home, and what appears to be basically just entirely new, almost 100% passive income stream you managed to create for yourself out of thin air. And, I think the question will be just, what's the catch here? Because I see the brokerage account, I see the dollar figures, but I also see no money put down up front. So again, what's the catch?
Yeah, it's a totally fair question, Eric, and I'm glad you asked it. Because let's face it, anytime something seems too good to be true, our minds are conditioned to expect some kind of angle or trick. In this case, Eric, it's that you only want to write puts on companies you'd be thrilled to purchase the stock in at a cheaper price if the share price falls, because that's a distinct possibility when you sell puts on them. Now, listen, I work for the Motley Fool. I've been really excited about Shopify for a long time, as I'm sure many of our viewers have been, as an investment, and I would have been thrilled to own it when I was writing these puts back in 2017. But as we all know, it's a very successful investment, one of the most successful in Motley Fool history. And even back in 2017, it was already up more than 3x in value from when David Gardner originally recommended it back in February of 2016. So whether for right or wrong, again, as I said before, I'm no analyst, I thought Shopify stock was a little frothy at the time. If I was going to get in, I wanted it in at a slightly cheaper price. As we know, the stock has just continued to take off since then, so that lower price never came. I was able to just continue writing puts literally for months on end, and ended up making more than $3,000 in the process with no outlay of capital whatsoever.
But your point is, if Shopify's share price had pulled back, you would have been required to purchase 100 shares of stock. So even though it's technically at a discount, because the stock has just fallen, you never want to have to buy shares of what you personally consider, well, a bad business.
That's exactly right. And I actually have another personal example that shows how only writing puts on companies you'd be happy to own anyway can really work in your favor and sets up what I think is kind of a true win-win scenario, kind of the other side of the coin to my Shopify example just now.
Yeah, let's hear it.
So, Eric, you've worked in tech quite a bit here at the Motley Fool, so you're probably aware of Teladoc Health. Obviously not as well known as Shopify, which is a beloved Fool pick, but it's another one of our best recent picks here at the Fool. They basically do remote medical consultations, so you don't have to go into a doctor's office. Probably plenty of you, if our viewers, if you've had a telehealth appointment in the last year, there's a reasonable chance that you use Teladoc software. Perfect timing with the pandemic, as you can imagine. Well, they went public back in 2015, and they're already up around 6x. We actually have it as an active buy recommendation in 10 Motley Fool services right now, so it's done really well for us as a company. Anyway, back in 2019, I really liked Teladoc. But again, just like Shopify, it had already gone up a lot, and I would have preferred to get it at a slightly cheaper price. So on July 12th, 2019, Teladoc's share price was $70.62. And I wrote a put with a strike price of $65 and immediately pocketed $176.29. So, my commitment was if Teladoc's share price fell to $65 or lower, then I might have to buy 100 shares. Same playbook as with Shopify, right? Well, not exactly, because just a month later on August 16th, Teladoc's share price did in fact dip down enough that it crossed that $65 threshold. Now, when you sell a put and the share price dips below the strike price you sold it at, you're forced to purchase 100 shares of the underlying stock. It's called being assigned shares. But again, Eric, and this is the crucial part, this is the thing that I think far too many options investors or traders miss. I was perfectly happy with that outcome. I already thought Teladoc was a great company, and I got to buy shares at a price I considered a total bargain, and I got paid to do so. So that's 100 shares at $65 a pop for a total outlay of $6,500. Of course, you subtract the amount that I'd already gotten paid, the $176.29, that drops to $6,330, or cost basis of $63.30 per share.
Yeah, and as you said before, Teladoc has not only been one of the more impressive performers over the past few years for us here at The Fool, but because all their business is conducted remotely, well, it's essentially tailor-made for work at home and this pandemic environment. So I think I know where this is going, Michael, but how about you tell everyone at home where those shares have gone?
Yeah, I've done pretty well so far. So, remember, I had to buy shares at an adjusted cost basis of $63.30 after my initial income for selling the put back in July of 2019. A little more than a year and a half later, Teladoc is trading at right around $171. And as you can see, I've asked Heather, our producer, to go ahead and post a snippet from my brokerage account. I'm personally up $11,144 off a single trade.
And I think for those of you watching at home here, again, there are only two real outcomes when you sell a put. You can either, one, continue writing them and just keep on collecting income time after time after time because the share price never breaks your strike price threshold. Or the second option, the share price does drop enough that you're able to buy the stock at a deep discount. So is it fair to say the takeaway here is that as long as you're happy to own those discount shares anyway, you're basically always in a win-win scenario?
Well, that's exactly right, Eric. And in my case, I think it's interesting. I had these two different stocks that I loved in Shopify and Teladoc, made the exact same type of extremely basic options trade. In this case, selling a put, but the outcomes of selling the put were the exact opposite. And yet, I made a good amount of money in both scenarios with hardly any work on my part in the process. I mean, that's, as far as I'm concerned, a true win-win.
Yeah, and I'm guessing people watching at home, all of this sounds like a relatively Herculean task of learning how to make all these options trades on your own. So, Michael, you've learned how to do options from the option service. Was this the case for you? And if not, what made it so easy?
Yeah, I mean, I think the thing that really just made a difference was that the options team is just so good about teaching and explaining just every exact piece of what you need to do and sort of what it takes to do this. And you've already seen the example from the brokerage, from my brokerage. It's a pretty simple process when it comes down to it. But the thing is, you don't want to mess it up, right? And the nice thing is that the team just lays it out. Hey, this is the price. This is the date. This is roughly the amount you're looking to pay for it. And they just make it, so simple and just plain English that you can just kind of follow it piece by piece, which is exactly what I did when I showed you that potential trade in my brokerage account.
Yeah, and as I mentioned earlier, we do have a pretty big announcement today, so let's get to it right now. I'm incredibly excited to announce that for the first time in 5 full years, we're publicly opening the doors to Motley Fool Options via special offer. Michael, do you want to talk a little bit about why we're making this decision and doing it today?
Yeah, that's a great question, Eric. And the reason is I think the timeliness is huge, right? We are seeing some of the highest recorded interest in options trading that we've ever seen since either of us has been to the company. And, well, between you and me, we've been here a combined 2 decades. We know the rise of meme stocks like GameStop and AMC, which everybody's heard about in the news at this point, is a big contributing factor. But the problem is that all too many people who tried to follow in on those trades ended up losing their shirts in the process. And that's just a terrible and a heartbreaking thing. For us, if people are interested in options, then we have a duty to help them do it the right way. And when we have this, 86% win rate, I think it is it's imperative that we help, be out there to educate people so that they can do this the right way with a team that has such a long-term track record of success. I mean, listen, you've probably heard Warren Buffett's #1 rule of investing, right? It's to never lose money. And rule number 2 is to never forget rule number 1, right? That's the ongoing joke. You never want to lose money. Obviously, it's impossible to never lose money. But with the options team's 86% win rate, I mean, across a decade of options investing, I mean, in my opinion, that's just such a long-term, consistent success rate that's about as close to perfect as I think anything we're going to get. And of course, with the market taking a bath over the recent weeks, option strategies like Leaps and the trifecta trade we demonstrated earlier are a fantastic way to take a long-term position in a stock that have just given you a cheaper entry point while still putting far less money at risk up front. In my opinion, this hyper volatile market we're in right now is the perfect time to set yourself up for more upside while directly capping that downside up front.
Yeah, and Michael, you showed it earlier in the video that for bull stocks that really sometimes define entire eras like Shopify and Teladoc, it's often not easy to find an attractive entry price. So I think right now with the option strategies we're employing, it's an excellent time to get started on many of these stocks that, as you just noted, are at significantly more attractive entry prices. So now that you know why we're fully opening Motley Fool options up for the first time in half a decade, let's dive into what people get when they decide to become a member.
Yeah, this is the fun part, right, Eric? So to start with, right off the bat, folks will get 3 brand new, what we call set and forget strategies. One each in April, May, and June. Those will run all the way until the beginning of 2023. And so again, that's that really ultra long-term trade that we were showing earlier. That's just, we think a really big, long-term opportunity for folks to, again, target that leveraged upside and limit the capital risk up front and give a really long time for the thesis to play out. We'll also get monthly, what they call ongoing strategies that aim to generate income in overlapping 3-month intervals. We'll be keeping an eye on these ongoing strategies much more actively, and the team will send you an alert straight to your inbox the second they think it's time to take action. Plus, you'll receive our monthly Always Have a Plan write-ups on the first Friday of each month, which prime you on what to expect from your membership inside Motley Fool Options over the course of the coming month, including setting the table for any impending expirations on current options trade recommendations and sort of what the opportunities look like from there. Now, as someone who's on the options website very frequently to follow the guidance and trade recommendations there, I can say with confidence, between the set and forget strategies and the constant influx of new, ongoing strategies, there's a lot of options plays to choose from.
Yeah, Michael, I think the really important note is I've spent some time on the options website as well. And one of the nice things is some option services can become very overwhelming having to follow trades. But I think what we've established here is kind of a Goldilocks where it's not too many trades that you start feeling overwhelmed, but there also aren't so few that feel sparse. It's just the right level, in my opinion. And changing gears from our trade recommendations themselves, Michael, you touched earlier on how easy Motley Fool Options made it to get up to speed on how to trade options based on Jim Mueller's experience. But there's another unique, incredible education resource that fools get access to the second they join Motley Fool Options, called Options U. And we actually have a pre-record video here to break it down for you. Heather, would you mind rolling that video?
Hi there, I'm Sam Barker with The Motley Fool, and I'm going to tell you a little about our exclusive Options University platform, which you'll gain immediate access to the second you become a full-fledged member of Motley Fool Options. Now think of Options U as an extremely condensed, plain English version of an online course you can go through at your leisure, and then refer back to at any time throughout your Motley Fool Options membership. Options U is divided into 3 distinct stages: Options Essentials, Options Strategies, and Options Masters, which will help you quickly and efficiently progress your understanding of how options work. Each of these 3 stages also has multiple modules inside that build on each other in a neat and orderly progression, so you never feel like you're just skipping around randomly. Plus, unlike many exhausting online courses, each of the individual modules here will only take anywhere from 5 to 10 minutes at the very most to read through. So you could easily knock out the entirety of Options U in half a day if you wanted to. Now, if you're brand new to options investing, you'll definitely want to start with Options Essentials. In Essentials, you'll learn about the rudiments of options, such as what exactly an options contract actually is in the first place, how to quickly and easily sign up for options trading permissions with your broker, the difference between puts and calls, and the difference between buying and selling options. Once you have a hold on the basics, you'll move on to Options Strategies. This is where we'll walk you through the mechanics of the most basic kinds of options trades that you can make in your brokerage account, such as how to buy calls to maximize upside on even the most modest share price movements from stocks that you love, as well as how to sell puts to potentially set yourself up for a string of consistent, repeatable income. With a confident grasp of basic option strategies, It's time to move on to the final stage of Options U, Masters. Now, this is where you'll find full breakdowns on more advanced tactics like synthetic longs, which allow you to take a bullish position in the stock without spending a single penny up front. Strangles, which gives you the ability to turn a profit if the stock makes a severe movement in either direction. This is great for highly volatile companies. Or bearish spreads, which allow you to get similar effects to shorting a stock, but while simultaneously capping your downside in the process. Now, if those sound a bit too advanced, don't worry. You could easily be an incredibly successful options investor without ever utilizing a single strategy from the Options Masters playbook. Think of it as a graduate level course at Options U. And remember, not only is Options U a great way to quickly learn how to trade options in the first place, it's also set up to be an invaluable reference guide anytime you need to brush up on something you may have forgotten. With Options U, you'll be trading options like a grizzled veteran in no time. We'll see you on the inside.
And as you see, I mean, what you've seen is basically what you get in terms of it's simple, it makes sense, and to me, it's just like a very sort of natural flow on the site. And they just kind of lay out everything in really plain, simple English so that it's very easy to sort of learn what you need to do to get started and then just go.
Yeah, Michael, I think we've all had the experience of looking for options information across the internet, and you never quite know what you're going to get. So it's really at a premium in the space to have that content in one centralized place. And one last thing I want to add, I know there are common concerns with people around options, but if you're worried about anything from how to set up options permissions with your broker, to tax implications of options, to setting up your first options trade in your account, to just having a glossary of options terms at your disposal, we literally have reports on all those things inside Options. And I know they can sound scary before you join, but most members find that once they get onto our private members-only Motley Fool Options website, so everything just immediately becomes easier to understand and manage because you've got your answers, once again, to pretty much every question you can imagine right in one place and at your fingertips.
Yeah, that's right, Eric. And if anyone's wondering about getting, options permissions from your brokerage, honestly, it's a piece of cake. What I did was I called them up and said, hey, I'm looking to get options permissions. They sent me a form to sign. I turned it back around to them. I mean, honestly, it was one of those things that took 5 minutes. And of course, you don't need to just take my word that options is simple, easy, and, well, incredibly powerful. Here's what your fellow options members have to say.
Well, I really lucked out. I got involved with the options service a little over 2 years ago, and with the condition of interest rates and the like, and you have your allocation of fixed income, and what to do with that. You really don't want to get involved with too much on the fixed income side. I've learned 150 times what I knew about some simple option strategies that provide income.
With Motley Fool Options, I've had a great opportunity to learn how to sell puts on the products and the stocks that I want to buy, and therefore buy them a lot cheaper. So it's been really profitable.
Those folks have really helped me understand the different technical things like puts and calls, and just allowed me to comfortably get started with them in a really safe way and not perform all the risky activities that are usually associated with options.
And I was always leery because when you hear options, you think, oh, high risk. But the simplest example is the selling of puts in some good name companies. If the market turns on you and you wind up having to buy those companies at a lower price, so be it. But in 8 out of 10 put sell recommendations, I've just been pocketing the income, and it's just been a wonderful service.
I think it's a tremendous generator of cash flow. People think of options, most of the people you talk to, as a very aggressive speculative strategy, when in reality, if it's used, it can be very, very conservative.
Well, I own a house in San Francisco now, largely due to the fact that I bought a membership in Motley Fool Options.
And now the moment everybody has been waiting for, Michael. just how much is access to Motley Fool options going to cost?
Because it's the first time we fully opened up options to the public in 5 years, we wanted to put together a truly special membership offer on behalf of Motley Fool members. Just as sincere thanks for turning into our first ever options masterclass today. Which is why, in addition to everything you've already seen today with Motley Fool options, you'll also get full access to our VIP benefits package at no additional cost. As an Options VIP member, you'll get access to 2 exclusive, never-before-seen special reports. The first is basically because we recognize that options themselves aren't the only way to profit off, frankly, the highest level of options trading volume we've personally ever seen. The first report is titled 3 Stocks to Buy and Hold for the Options Boom. Because we also know that a vast majority of our new members will indeed be first-time options traders, our second VIP report is 3 Do's and 2 Don'ts when investing with options, just meant to help set folks up for success from day one. The third and final item in our VIP package is an exclusive digital Q&A with our entire team here at Motley Fool Options, including options guru Jim Mueller himself. You'll be able to ask them any and all options questions you may have to start immediately getting the most out of your membership from day one. Now, of course, as our lawyers always ask us to note, please just remember we cannot offer personal financial advice of any kind. Now, I'll start by saying that in the past, we sold Motley Fool options for as much as $1,499 for just a single year of membership, and thousands of Motley Fool members just like you were happy to join at that price point. Now, that said, I understand that kind of premium tier price is simply too steep for many of our less veteran members here at the Motley Fool, which is why, in the spirit of this being the first time we've made Motley Fool options available on special offer in the past 5 years, and in acknowledgement of all of the interest around options that we're seeing right now and our sincere desire to help people as much as possible, we're making the service available at a far more readily affordable price. It gives me great pleasure to be able to announce that when you become a VIP member of Motley Fool Options by midnight tonight, you'll be able to do so for just $799. Considering not only the previous price we've sold options at in the past, I think that's a pretty incredible steal. Not only is it nearly 50% cheaper than what we've sold options for in the past, remember, I personally made more than $3,000 in a single year just by repeatedly selling puts on Shopify. I would have made my membership fee back 3 times over. And then just the final thing, I understand that many of you at home are brand new to options investing, and it's probably scary if you'd imagine diving in. Certainly it was for me when I started, which is why we also have our 30-day ironclad satisfaction guarantee in place. So here's how it works. It'll allow you to join with confidence, test out everything that Jim Mueller and our Motley Fool Options team have planned on our members-only website for a full month. Be able to see every one of the trades that contributed to that 86% historical profitability rate, including full access to all of your VIP bonus perks. And then if by day 30 of your membership you come out thinking, yeah, the options really aren't for me, that's no problem whatsoever. You can just call our helpful member support team here at the Motley Fool, and they'll help transfer your options membership credit to any of our other premium tier portfolio products here at the Motley Fool. What are your thoughts on that, Eric? Pretty great offer, right?
Yeah, I think there's a few points really worth emphasizing. First of all, you've mentioned it earlier, but the volume on options is simply exploding right now. It is the highest throughout history, and that's because options truly have become easier to use than at any point in the past. But at the Motley Fool, we take a couple things very seriously. Number one, we take our customers' trust to be all important. And second, we want to ensure that you have the right strategy for these markets. The Motley Fool's built its name on having the right strategy for investing. And we also believe we have a specific type of strategy for options that you'll only discover inside Motley Fool Options. So for those of you at home, if you're new to options or think about getting into it, we take so seriously putting in the efforts to build reports to make sure you're getting complete information as simply as possible, as easy, as pain-free. I believe this is the best service in the world for options novices. And second, let's say you join. And for whatever reason, you just decide options might not be right for you. Remember, this includes the 30-day satisfaction guarantee, which I think just really takes the pressure off committing to Motley Fool Options long-term if it simply ends up not being right for you. You can come in, you can try everything out, you can try some trades. If you don't like it, hey, we have tons of other services which you can switch to. And then just finally, the price. This is one of the more affordable higher end product offers we've made available anytime in recent memory here at the Fool. And again, it just all revolves around trying to make this as much of a no-brainer as possible for investors trying to dip their toe into the options pond for the very first time. So Michael, Michael, the value for options is truly incredible. This has to be one of the best deals I've ever seen us offer here at the Fool. Now, we are about out of time today, so I'd like to thank you, Michael, for joining me today. A special thank you for everyone at home for tuning in. I'll reiterate one final time that your early bird discount to options will indeed expire come midnight tonight. So if you have any remote interest in anything you've seen today, please just bear in mind that the price you'll see if you want to join tomorrow will be different than what you'll have until midnight tonight. So before midnight, simply scroll down directly below this video player to open up your full early bird invitation to join us inside options. You will find a comprehensive list of membership benefits, pricing terms, and all the information you need to know to make an informed decision. Now, with that said, I want to thank you again so much for your time. I hope you've learned how simple options can be. I hope you've really benefited from some of the trades that we've shown, and we're excited here at the Motley Fool for building a foolish way to trade options, get more upside potentially with less capital at risk. With that being said, that will conclude today's event, and I hope you have a wonderful day and Fool on.